8 Effective Forex Trading Strategies. By engaging in Forex trading, one has the chance to participate in a hugely promising global market. Forex has even developed a reputation for making quick gains as a result of its popularity among day traders. In actuality, it's every bit as intricate and fiercely competitive as any other global market. You must comprehend the market and fine-tune your trading strategy if you want to not only be successful but also succeed consistently. There are many different approaches to trading Forex, so it's crucial to pick one that fits your level of experience, your objectives, and the situation at hand. To help you find the right fit, we've outlined the fundamentals, advantages, and disadvantages of 9 well-liked Forex trading strategies below. 1. Trend trading. One of the most dependable and straightforward Forex trading strategies is trend trading. This kind of trading strategy involves trading in the direction of the current price trend, as the name would imply. Traders must first determine the general trend's strength, direction, and duration in order to do this effectively. They can determine the strength of the current trend and when the market may be ready to reverse it based on all of these variables. In a trend trading strategy, the trader just needs to be aware of when to exit their current position in order to lock in profits and reduce losses, not the precise direction or timing of the reversal. Even in a market that is trending, there will inevitably be minor price changes that buck the general trend. Because of this, trend trading prefers the long-term strategy known as position trading. When making investments in the direction of a strong trend, a trader should be ready to tolerate minor losses because, as long as the general trend is maintained, profits will eventually outweigh losses. For obvious reasons, trend traders prefer trending markets or those that move relatively predictably between overbought and oversold thresholds. 2. Position trading. Using the position trading strategy, traders hold their positions for a long period of time, ranging from a few weeks to a few years. When used as a long-term trading strategy, this method calls for traders to maintain smaller market fluctuations that oppose their position. 3. Range trading. Support and resistance serve as the foundation for range trading. The highest and lowest point that price reaches before turning in the opposite direction are known as support and resistance levels on a price action graph. These levels of support and resistance come together to form a trading range with brackets. A stair-like support and resistance pattern is formed in a trending market when price keeps breaking through previous resistance levels and making higher highs in an uptrend or lower lows in a downtrend. However, price moves in a sideways pattern and stays confined to pre-established support and resistance thresholds in a ranging market. Traders anticipate a reversal in the opposite direction and sell when price reaches the overbought resistance level. Likewise, as price moves towards the oversold support level, it is regarded as a buy signal. Finally, if price moves outside of this established range, it might signal the beginning of a new trend. Range traders are more interested in markets that oscillate between support and resistance levels without trending in one direction for an extended period of time than they are in predicting breakouts, which typically take place in trending markets. 4. News trading. Forex is a multinational market that is impacted by world economic developments. Trading strategies that help traders predict short-term, intraday or multi-day market movements, or breakouts, include understanding economic news events and their potential effects on currency pairs. 5. Swing trading. The goal of swing trading, a trend-following strategy, is to profit from sudden spikes in price momentum. These smaller spikes and dips may defy the direction of the prevailing trend, necessitating a more constrained market outlook. Examining 15-minute, hourly, daily, and weekly price charts as opposed to analyzing overall market trends. Swing trading is typically preferred by day traders who are available to monitor changes in price momentum minute by minute because it requires quick action and close market oversight. Although it is considered a short-term trading strategy, this method requires traders to hold their position overnight, unlike day trading, and may keep them in a trade for a few weeks at a time. 6. Scalping. With the aim of slicing small profits from each trade, traders who use the intraday trading strategy known as scaling buy and sell currencies. Scalping tactics in Forex are frequently built on a continuous analysis of price movement and an understanding of the spread. A scalper purchases a currency at the current ask price with the expectation that the price will increase sufficiently to cover the spread and generate a small profit. However, in order for this strategy to work, they must wait for the bid price to exceed the initial ask price before flipping the currency before the price fluctuates once more. 7-day trading. By concentrating only on intraday price changes and profiting from the volatility that occurs there, day traders establish themselves as such. The current levels of supply and demand are what are causing these minor market fluctuations, not the underlying market dynamics. 8. Retracement trading. A retracement is when the price temporarily reverses course before moving back in the direction of the dominant trend. Technical analysis is used by traders to spot potential retracements and separate them from reversals, instances when price changes direction but does not correct, forming a new trend. The trader may choose to hold their current position in the belief that the current trend will eventually continue if they anticipate a brief dip or surge in price to be a retracement. On the other hand, if they believe that the market movement is a precursor to a reversal, they may decide to leave their current position and take up a new one in line with the change in the direction of the trend.